Accruing unpaid expenses. This segment's learning objective is to prepare adjusting entries to accrue unpaid expenses. Some expenses accumulate or accrue in the current period but are not paid until a future period. These accrued expenses are recorded as part of the adjusting process at the end of each period by debiting the appropriate expense. For example, salary expense, interest expense, or income taxes expense, and by crediting a liability account, for example, salaries payable, interest payable, or income taxes payable. In future periods, as cash is disbursed in settlement of these liabilities, the appropriate liability account is debited and cash is credited. One of the keys to understanding the accrual of expenses is to realize that an expense has been incurred in the current accounting period but will not be paid until the following accounting period. For example, you may purchase gasoline from the local service station using a credit card. You have incurred the expense for the gasoline but have not recorded the cost. You probably will not record your expense until the following period, when the credit card statement comes. Companies cannot follow this practice because expenses would be recorded in the wrong accounting period and thus violate the matching principle. The adjusting entry required is to debit or increase an expense account and credit or increase a liability account. Almost all expense accruals will require this type of entry. Some common accrued expenses include interest owed on loans, wages and salaries owed to employees, and property taxes owed to the local taxing authority. Here is an example of accrued wages. Overnight, like many businesses, pays its employees every other Friday. This month, however, ends on a Tuesday, 3 days before the next scheduled payday. Thus, Overnight's employees have worked for more than a week in December for which they have not yet been paid. Time cards indicate that since the last payroll date, Overnight's employees have worked a total of 130 hours. Including payroll taxes, Overnight's wage expense averages about $15 per hour. Therefore, at December 31st, the company owes its employees approximately $1,950 for work performed in December. On December 31st, Overnight owes wages of $1,950. Payday is Friday, January 3rd. As with most expense accruals, Overnight will debit an expense account, in this case wages expense, for $1,950 and credit a liability account, in this case wages payable for $1,950. The wages earned by employees during December will be recorded in the proper period. Initially, an expense and a liability are recorded. The balance in the wages payable liability account is $1,950 and will appear on the balance sheet of Overnight at December 31st. The wages expense account will be increased by $1,950, and this amount will be included on December's income statement. Employees earned an additional $447 on Wednesday through Friday, January 1st through 3rd. Let's look at the entry Overnight will make on payday, Friday, January 3rd. We need to be careful because part of the $2,397 of total wages expense has already been recognized. Make this entry to record the wages on January 3rd. Wages expense should have a debit for $447, the portion of the total payroll applicable to January. Next, eliminate the wages payable by debiting the account for $1,950. The balance in the wages payable account is now zero. Finally, credit the cash account for the full cost of the payroll, $2,397. The liability is extinguished when the debt is paid.